Welcome to the Zero Dash DTE podcast. At 0 days to expiration, the zero dash, that's referring to the URL. It's zero-dte.com. And if you want to find us on YouTube, it's just 0 days to expiration. What we're all about is discussing and exploring and talking about and showing how an option strategy with the SPX, that's the SPX index, using asymmetric outcomes, can be the best possible trading strategy that's out there. Whether it's day trading or swing trading, I don't really care. When we talk about day trading or swing trading, really the difference is time. And the more time that you have in front of you in order to expect a particular outcome, the greater the odds are that you're going to fail or that there's something going to happen that you don't expect to happen. If you can reduce that time down to a very small, well-defined, manageable range of time, you have a much better chance of figuring out, well, where price is going to go. I think that goes without saying. And that's actually expressed in the pricing of options too. The further something is out in time, the greater the volatility, the higher priced it is, because you're taking a much larger chance. Now, if you could compress all of that and get the same kind of inflated premium that you would get from looking at something that's far out to something that is very close, and then put the odds in your favor, you would really have something. Now, in terms of asymmetry, there are two different ways that most people trade. They trade either with a high probability trade, thinking that, okay, I'm going to create income for myself. I'm going to trade so that I have a really high probability of making a tiny little bit of money with each individual trade, and then the chance of blow up or hitting the risk is really small. And if that risk does come along, I'm going to find a way to manage it. Of course, what happens is that you hit that risk way more often, I should say, than you ever intended. And the risk is usually way bigger than you thought. And the result is that most people that are choosing these high probability, quote, income trades end up being losers. So the flip side of that is to take very tiny risks for a very large outcome. With that, yeah, it may seem like the reward is way out there, something that may be unattainable. But the risk that you're taking is very small, so it never really hurts. So there's really no management of your position. There's no anxiety that you experience like you do with low probability trades. And when you do hit that jackpot or you do hit the winner, then your outcome is just tremendous and you're ahead. Now, if you took this to an extreme, let's say that your odds were 1 in 10,000 to win $10,000. Okay? And then every time that you took a chance, it cost you $1. If you took that to its logical extreme, then at the end of, let's say you hit 1 out of 10,000, but you did it on that very last try, you would be out $1,000 or $999. But if you flip that, and let's say that the odds of winning were 999 out of 1,000 to win $1, then you're going to consistently win that $1 and you think that you're fine. But if you lose $10,000, now the odds are one thing, but the reality is that if you were to look at these two scenarios, the odds of you not hitting the worst possible scenario or the best possible scenario at your last chance are very small. It's going to happen somewhere in the middle. It's likely to happen before you go through that entire series. And so in that case, the positive outcome is definitely on the low probability trade with the high outcome, or the low risk trade with the high outcome. And we can see this when we do simulations, and actually we see it all the time in practice. But if you do a simulation, Obviously, you're not going to want to do 1,000 trades with a chance of 1 in 1,000. But if you bring that down to real terms and make all of your trades very asymmetric or very widespread from the risk to reward, you'll find basically the same thing. You'll find that while you're trading with small risk, you never really have to manage that risk. And it's never really a burden on you. And of course, in reality, it's not a binary thing. We're not either winning a large amount or winning nothing at all. There's usually some sort of spectrum. So you're constantly making some money, but every once in a while you make a big amount of money. But the risk is always small, so you're never falling off the cliff. You're never experiencing big drawdowns. But if you go the other way around, like the way most people are trading, with small probability, with large risk, you will have maybe those incremental wins, but then you're going to have huge drawdowns. What happens if you have consecutive trades that are losing trades where you hit that really bad outcome? And we all know that happens. But when you start compressing or reducing or bringing the risk to reward more in line, let's say 1 part risk to 10 parts reward, you start seeing this difference in real life, in real terms, in the same way that you would do the high probability trade. Maybe you make 10 parts risk to 1 part reward. You'll see that you have, in general, a negative outcome with a high probability trade, and you have a positive outcome with a low probability trade. And in fact, with the low probability trade, the difference is that you're never really sweating the risk, because there's never a reason to sweat the risk. Where in the high probability trade, you're constantly sweating the risk. Now, a good example of this would be 2 different types of trades. Now, what we're really talking about here with 0DTE is premium collection. And there are a number of different types of premium collection strategies. And if we were to look at 2 different types, let's say an iron condor. Generally, the accepted methodology of trading iron condors with the SPX in a 0DTE situation, or the very final day of expiration, is that you put on a very wide iron condor, very high probability trade, but it has massive risk. So in other words, you might put on a trade that has $1,000 of risk for the potential of making $50. Actually, let's say for $100. Let's keep it simple. And the way the trade typically goes is that you'll center price on that iron condor and figure that, man, there's a 95% chance that I'm going to be in the money. But the reality of what actually happens, and because the risk is so big, price starts to move as price normally does, a lot like it did today. It's moving up and down all over the place. So when you put on that trade, the profit curve inside of that iron condor isn't flat across all those prices. In fact, you may start out at zero loss, zero profit, but as soon as price moves, you start moving into negative territory. And in fact, if price moves too far, you can move into dramatically negative territory. And if it starts threatening the wings of your iron condor, you could be looking at $600, $700, $800, or $1,000 loss, the max loss. So as soon as you put on that high, quote, high probability trade, you are in constant anxiety, right? Because as soon as price moves, you're in the red, and potentially in the red by a very large amount. So what practitioners of this type of strategy would do is that they would say, I'm going to limit my losses to 2 or 3 times the expected premium that I might collect. So now they are taking the exact same shaped curve at the beginning of the trade, which is very steep. So it's like sitting on the top of a mountain, and if you go either way, you fall off the sides. And then taking the very wide wings that have the high probability and then bringing them way in so that you have an automatic loss should you go too far to the left or to the right of price. So now you're taking that high probability trade and trading it for essentially a medium or a low probability trade, right? So now you bring that in, and maybe the chances are only 60 or 65% that you're a winner. However, there's a much higher chance that you're going to be a loser, where you're going to lose 3 times, maybe $300. You eliminate the big risk, but still, you are now a loser more often than you're a winner. And the wins that you take, you don't take that 100% because you're so nervous about whether or not you're going to challenge that wing or that stop that you've put on. The strategy that most people adopt is that they take, as soon as they hit 50% return on that premium collection, they get out. So now it's not a 3 times or even, let's say, 2 times risk that you're taking. It's actually double that because it's half the amount of premium that you're going after. So you take less risk for less, you take way more risk for less profit, and still you're anxiety ridden. This kind of trading simply does not have a positive outcome. If you were to play this out over a long period of time, at best, if you played this over and over, you might break even. But more often than not, you're going to lose money. And in the meantime, you're only going to make small wins and have very large drawdowns and be anxiety ridden all the time. So I just described what most people are doing in 0 DTE with the SPX. What we do is we do something that's completely different, the opposite, or what I call the inversion of risk. So instead of using an iron condor, we use a butterfly. And we don't center the butterfly on price. We put it out of the money. And what we use is a concept known as probability of touch, and place the center of that butterfly in its closest long wing within, say, a 65% return. So in other words, there's a 65% probability that we will touch that wing at some point. And our risk to reward will be, say, 1 to 10. Potentially, we could make 10 times our money. But the max we could ever lose is that 1 times. So right off the bat, in any case, we have the same relative probability of profit, but we have 1/3 the potential loss and more than 20 times the potential win. And the spectrum of wins in between are great. And there is zero anxiety between those because we never experience that falling off of the gamma curve that you do in the iron condor. In fact, because we're dealing with premium collection and end of expiration, that premium curve, because of the nature of the butterfly, is constantly rising in our favor. So if we're anywhere near the butterfly, we don't even have to be inside of it. You could be making profit, sometimes as much as 200, 300% without ever actually being in the profit tent. Of course, if you're in the profit tent, then your probability of profit has risen dramatically. And the amount of profit that you can make relative to your risk is orders of magnitude greater than you could with the iron condor strategy. Now, of course, this requires a little bit more attentiveness to some details about where we place our butterfly, where we place the center strikes. And it's really not that difficult. We're never using, first of all, any kind of technical analysis. We only use volumetric information, volume profile and volume flow, to determine where price is likely to go. Even if we were going to do it from a random point of view and simply just choose something that is within, say, 50% chance of touch of one of the long legs, we would still be winners. But we can improve our probability of touch or probability of profit through the analysis of volume profile and volume flow to get us closer and give us a higher expectancy of being inside of that profit tent or near it. Again, being inside of it is not, it's not really a requirement at all. Just being near it is fine. And we still have a higher expectancy of total profit and a much lower expectancy of potential loss. And the biggest part about that is that we never feel any anxiety, ever. The other result of this is that over the long term, we never experience those big drawdowns that you do in other strategies, the high probability strategies. High probability strategies often bring with them huge drawdowns, and they leave you dejected. In our strategy, you hardly ever experience more than, say, an 8 or 9% drawdown, even in the most aggressive ways of trading the strategy. The only way you would achieve greater than that is if you simply overtraded. And of course, that's a problem no matter what strategy you're trading. So in other words, if you decide to bet the farm, back up the truck, that sort of thing. But if you follow the strategy and right size bet, you never have a significant drawdown. And you have nothing but a nice smooth equity curve. So that's the other benefit. Very little volatility in that equity curve. So it looks like this, where low probability trades look like this, and usually going down. That's really the end result. That's what is ultimately going to happen in high probability trading, and that is a negative expectancy. There's math to this, and Nassim Taleb talks about it in great detail in his book, Fooled by Randomness. But the big difference here is that feeling that you get, or that level of comfort that you have when you're in a trade and you're not feeling that anxiety. When you are not anxiety ridden, you have a different level of confidence. That level of confidence, that brings along with it clear heads, clear mind, the ability to think rationally and make more rational, better decisions. So every way that you look at it, even though it may seem counterintuitive that you're taking low probability trades, every way that you look at it, you actually make more money, lose less money, have fewer drawdowns, have less anxiety, and you make better decisions. That's the difference between the way other people are trading zero DTE and the way that we trade zero DTE and what I call the inversion of risk. There's one other major difference in our service itself besides the strategy. The service itself is more of an educational service. I take on the success of every single student very, very personally. I am totally dedicated to make sure that people do what is necessary to follow this strategy. And the one thing that we do that I think is different than everybody else, rather than following some amount of criteria or some formulaic way of putting on the trade, is teaching people this process and making the trade their own. So we're teaching people how to fish so that they can come away from this with something that is theirs. And that's what's happening in our service. Many people have developed their own style of trading. And so what we just concentrate on, instead of the outcome, instead of making these lofty goals, we can just focus on the process, execution of the process, and getting better at that. And then from that, we have a successful strategy. What I think is the best strategy, best trading strategy for any day trader that's out there. It has built-in edge with the overstatement of volatility and the premium. You also have positive outcome taking asymmetric trades that are relatively low probability, but in essence about the same probability, but much higher potential outcome. So that's it. If you'd like to give it a shot, we have a 4-week trial. And after that 4-week trial, if you decide to join us, I'll rebate the cost of that trial, essentially making the trial for free. In either case, you're going to learn something rather spectacular. Thanks a lot. We'll see you next time. Have a good one. Peace.